The clock reads 4:47 a.m. Your alarm hasn't gone off yet, but you're already awake, staring at your phone in the darkness of your bedroom. Futures are down 2% in pre-market trading. Something happened overnight in Asia, and now European markets are bleeding red across every screen you're checking. Your heart rate picks up slightly, not from fear exactly, but from that peculiar mixture of adrenaline and focus that's become as familiar to you as your morning coffee. In 13 minutes, you need to be showered, dressed, and analyzing exactly what this means for the positions you're holding. Welcome to another day as an equity trader, where the world never stops moving, and neither can you. Most people think trading is about sitting in front of screens, making quick decisions, and watching money pile up or disappear. They imagine the chaos they've seen in movies, all that shouting and throwing of papers, phones pressed to ears while somebody yells about buying or selling. The reality is simultaneously more mundane and far more intense than any film could capture. Trading isn't really about individual moments of drama. It's about sustaining a level of attention and mental acuity that most people reserve for emergencies, except you maintain it for 10, 12, sometimes 15 hours straight, and you do it day after day until that heightened state becomes your baseline. By the time you're walking through the doors of your trading floor at 6:15 a.m., you've already consumed more information than most people process in a full day. You've read research reports, checked overnight market movements in Tokyo and Hong Kong, scanned headlines from London and Frankfurt, reviewed economic data releases scheduled for today, and mentally wargamed at least 3 different scenarios for how your positions might perform. The actual trading day hasn't even started yet, and you're already deep in the game. The floor itself has a particular energy that's hard to describe to outsiders. It's quieter than people expect, for one thing. The days of open outcry and physical chaos are mostly gone, replaced by rows of desks with multiple monitors, each trader surrounded by a fortress of screens glowing with real-time data. But the intensity is palpable. You can feel it in the way people move, the clipped efficiency of conversations, the constant darting of eyes between screens. Everyone is processing, calculating, weighing risk against opportunity in real time. Your desk is your command center, and over months or years, you've customized it into an extension of your own nervous system. 6 screens arranged in a precise configuration that makes sense only to you. The main screen shows your positions, every stock you're long or short, updated tick by tick. Another displays market depth, the order book showing you exactly who wants to buy or sell at what prices. A third streams news from multiple sources simultaneously, because information is currency in this business, and being 3 seconds behind on breaking news can cost you real money. The other screens rotate between charts, sector performance, portfolio analytics, and whatever specific data matters for your particular trading strategy. You're not just watching these screens, you're reading them the way a musician reads a score, seeing patterns and relationships that would look like chaos to an untrained eye. That stock moving up on heavy volume while its sector peers are flat, that's interesting. That sudden spike in volatility in the options market for a company with earnings tomorrow, that's worth investigating. The correlation breakdown between 2 stocks that normally move together, that might be an opportunity or a warning sign. Your brain is constantly processing these inputs, sorting signal from noise, building and discarding hypotheses in rapid succession. The opening bell at 9:30 a.m. isn't dramatic. There's no actual bell on the floor where you work, just a timestamp on your screen and a sudden explosion of activity as orders flood the market. This is when all that preparation matters. You've got positions from yesterday that are now reacting to overnight news. You've got new trades you planned based on your morning analysis. And the market itself is providing you with fresh information every second, confirming or contradicting your assumptions. The first hour of trading is typically the most volatile, and it requires your absolute focus. Your hands move between keyboard and mouse with practiced efficiency. You're entering orders, adjusting stop losses, monitoring fills, all while continuing to process the stream of information flowing across your screens. A company announces earnings that beat expectations, but the stock drops anyway. The market was expecting more. You need to decide in seconds whether this is an overreaction you can exploit or a sign that something is genuinely wrong. Your risk manager is watching. Your P&L is updating in real time, and every decision counts. People often ask what it feels like to make or lose significant amounts of money in minutes. The honest answer is that you learn not to feel it, at least not in the moment. You can't. If you're thinking about the money itself, about what you could buy with it, or what it means to lose it, you've already lost focus on what matters. The money is just a scorekeeping mechanism. What matters is reading the market correctly, executing your strategy with discipline, and managing risk intelligently. The money follows from doing those things well, and it disappears when you do them poorly. But make no mistake, the pressure is constant and real. You're playing with substantial capital, whether it's the firm's money or your client's money, and the weight of that responsibility never fully leaves you. Even traders with years of experience feel their pulse quicken when a position moves sharply against them. The key is channeling that stress into sharper focus rather than letting it cloud your judgment. Some traders develop elaborate mental frameworks or rituals to maintain emotional equilibrium. Others rely on rigid risk parameters that force them to cut losing positions before emotions can interfere with rational decision-making. Around mid-morning, the pace often stabilizes somewhat. The initial rush of opening volatility has passed, and the market settles into more predictable patterns. This is when you can zoom out slightly, review how your morning trades performed, and think more strategically about the rest of the day. Maybe you take a position that you plan to hold for days or weeks rather than hours. Maybe you close out something that worked well and lock in gains. Maybe you're just watching and waiting, because knowing when not to trade is as important as knowing when to pull the trigger. Lunch at your desk is standard. A sandwich eaten in 4 bites between trades. Taste barely registered. Some days you forget to eat entirely until your stomach reminds you at 2 p.m. The market doesn't stop, and opportunities don't wait for your meal break. Besides, stepping away feels dangerous. What if something happens while you're gone? What if you miss the signal that everyone else catches? This is the mentality that makes traders both successful and, if they're honest, a little bit crazy. The social dynamics of a trading floor are unlike any other workplace. There's camaraderie, certainly, but it's tempered by the fact that you're all competing for limited resources, whether that's capital allocation, the best trade ideas, or simply recognition from management. Information flows freely on some topics and is guarded jealously on others. If you've spotted an opportunity that you think others have missed, you don't exactly announce it to the whole floor. But if something major is happening that affects everyone, there's an immediate, almost instinctive sharing of data and analysis. Your colleagues are some of the smartest, most driven people you'll ever work with, and also some of the most difficult. Trading selects for certain personality traits: competitiveness, confidence bordering on arrogance, comfort with risk, and the ability to make decisions under pressure. Put 50 people with those traits in a high-stress environment where performance is measured objectively every single day, and you get a culture that's intense and not always pleasant. Egos clash. Stress manifests in sharp words and occasional outbursts. But there's also a shared understanding that everyone is under the same pressure, dealing with the same challenges, and that creates bonds of a particular kind. The afternoon trading session has its own rhythm. By 2 p.m., you've been processing information and making decisions for nearly 8 hours straight. Mental fatigue is real, and it's dangerous. This is when mistakes happen, when tired traders chase losses or deviate from their strategies because their discipline has been worn down by hours of sustained concentration. The best traders recognize their own patterns of fatigue and adjust accordingly. Maybe you trade smaller sizes in the afternoon. Maybe you focus only on managing existing positions rather than initiating new ones. Maybe you've trained yourself to maintain peak focus throughout the day, though that level of consistency is rare and usually comes only with years of experience. Market-moving news doesn't respect your energy levels. A Federal Reserve announcement at 2 p.m. can instantly change the direction of the entire market. A major company announcing a merger in the final hour of trading can create opportunities or disasters depending on your positions. You need to stay sharp. Stay ready because the market can humble you at any moment, regardless of how well your day has gone so far. The final hour before the 4 p.m. close is another period of heightened activity. Traders are closing out day trades. Institutional investors are making final portfolio adjustments, and there's often a flurry of volume as everyone positions for the overnight period. You're making decisions about what to hold and what to close. Keeping a position overnight means accepting the risk that something could happen while the U.S. markets are closed. Earnings announcements, geopolitical events, moves in Asian or European markets that will gap your stocks when trading resumes tomorrow. Sometimes that risk is worth taking because your analysis suggests the position will be profitable. Sometimes you close everything and go home flat, eliminating overnight risk entirely at the cost of potentially missing out on gains. When the closing bell hits and the market stops trading, there's a brief moment of release, a slight easing of the tension that's been building in your shoulders and jaw all day. But the work isn't done. Now comes the analysis of how you performed. You review every trade you made, examining not just whether it made or lost money, but whether the logic behind it was sound. The thing about trading that nobody prepares you for is how much of it happens inside your own head. You're constantly running simulations, gaming out scenarios, trying to predict not just what will happen, but how other traders will react to what happens. It's chess, but the board is infinite, and the rules change mid-game. You're trying to see 3 moves ahead while simultaneously reacting to what's happening right now, and the mental load is exhausting in a way that's hard to explain to people who haven't experienced it. Your P&L for the day is now finalized, and it's tattooed onto your consciousness, whether you want it there or not. Up $50,000, down $23,000. Flat after 12 hours of frantic activity. Whatever the number, it's not just a metric of today's performance. It's a referendum on your judgment, your skill, your worth as a trader, even though you know intellectually that any single day is just noise. That what matters is consistency over weeks and months. The emotional reality is that each day's result matters. String together enough winning days, and you're a genius. Hit a losing streak, and suddenly you're questioning everything about your approach. The aftermarket hours are when you do the deeper thinking that's impossible during trading. You read detailed research reports, analyze sector trends, study the charts and patterns that might inform tomorrow's decisions. You review your risk metrics, making sure you're not overexposed in any single position or sector. You talk with your team, if you're at a larger firm, discussing what worked and what didn't, sharing insights about market behavior. Or if you're a solo trader, you conduct this post-mortem with yourself, which requires a particular kind of honest self-assessment that most people find uncomfortable. By the time you leave the office, it's often 6:30 or 7 p.m. You've been intensely focused on markets for 12 or 13 hours. Your eyes ache from staring at screens. Your mind is still buzzing with the day's activity, replaying trades, wondering if you should have held that stock longer or cut that loss sooner. You're checking your phone compulsively for any after-hours news that might affect your positions. The separation between work and life is porous at best. This is where the lifestyle aspect of trading becomes clear. It's not a job you do and then forget about. Markets are global and continuous. While you sleep, trading is happening in Sydney and Tokyo and Mumbai. News breaks at any hour. Corporate earnings, geopolitical events, natural disasters, policy announcements, all of these can and do happen outside of regular trading hours, and they all affect the positions you're holding. So you're never truly off duty. That vacation you're on? You're still checking markets. That dinner with friends? You're excusing yourself to check your phone when you feel it vibrate with a news alert. The financial rewards can be substantial, which is why people are drawn to trading despite the stress and the hours. A successful trader at a major firm can earn bonuses that dwarf their base salary. A trader running their own capital can theoretically have unlimited upside. But the path to those rewards is littered with failures. Most people who try trading don't make it. They wash out in the first year or two, unable to handle the stress, unable to maintain discipline, unable to cope with the inevitable losses that come with the territory. Even among those who survive, only a small percentage become truly successful. What separates the successful traders from the failures? It's not intelligence, at least not primarily. Plenty of brilliant people fail at trading because they can't translate theoretical knowledge into practical action under pressure. It's not just risk tolerance either. Some of the best traders are actually fairly risk-averse. They just happen to be excellent at analyzing and managing risk. The key traits seem to be emotional discipline, adaptability, and a particular form of pattern recognition that's hard to teach. Emotional discipline means maintaining your process and strategy regardless of whether you're winning or losing. It means not getting euphoric after a winning streak and taking excessive risks, and not getting despondent after losses and abandoning your approach. It means treating each trade as an independent event rather than trying to make back losses or prove you were right about something. This is extraordinarily difficult because humans are emotional creatures, and money is inherently emotional. Learning to observe your own emotional responses without being controlled by them is a skill that takes years to develop. Adaptability matters because markets change. Strategies that worked brilliantly last year might stop working. Volatility regimes shift. Correlation patterns break down. Technologies evolve. The trader who rigidly sticks to what worked in the past will eventually be destroyed by changing market conditions. You need to constantly learn, constantly test new approaches, constantly question your assumptions, while simultaneously maintaining enough conviction to execute your trades with confidence. It's a delicate balance between flexibility and consistency. Pattern recognition is perhaps the most mysterious element. Some traders just seem to have an intuitive feel for market rhythm and movement. They can sense when something isn't quite right, when prices are too high or too low, when a trend is about to reverse. This isn't mystical. It's just the result of thousands of hours of observation, but it manifests as something that looks almost like instinct. You see a chart pattern and just know how it's likely to resolve. You read the order flow and understand what the market is telling you. This deep fluency with market behavior is what separates merely good traders from exceptional ones. The technology side of trading has transformed the profession dramatically over the past 2 decades. High-frequency trading firms now execute trades in microseconds, front-running traditional traders and capturing tiny spreads millions of times per day. Algorithmic trading systems process news and execute strategies faster than any human possibly could. As a human trader today, you're competing not just with other humans, but with machines that never get tired, never get emotional, and process information at speeds that make your nervous system look sluggish. This has pushed human traders either toward longer time horizons, where patient analysis and strategic thinking still matter more than speed, or toward highly specialized niches where human judgment remains valuable. Some traders focus on complex situations like mergers, restructurings, or special situations where algorithms struggle with the nuance required. Others trade smaller, less liquid stocks where human intuition about company fundamentals still provides an edge. The purely mechanical aspects of trading, executing simple strategies based on technical signals, have largely been automated away. Your relationship with technology is therefore complex. You rely on it constantly, couldn't function without your multiple screens and direct market access and instant news feeds. But you're also competing against it, trying to find edges in places where machines haven't yet displaced human judgment. You're using technology to enhance your capabilities while simultaneously trying to do things that technology can't easily replicate. The psychological toll of trading is something people rarely talk about honestly, but it's significant. The constant stress, the emotional roller coaster of winning and losing, the isolation that comes from staring at screens all day, the difficulty of maintaining relationships when you're mentally preoccupied with markets even during your personal time. All of this accumulates. Some traders burn out spectacularly, suffering breakdowns or developing stress-related health problems. Others just quietly drift away from the profession after a few years, exhausted by the grind. The successful long-term traders are typically those who found ways to manage the stress and maintain some semblance of balance. They exercise regularly, using physical activity as an outlet for tension. They develop interests and relationships outside of trading that provide perspective and emotional sustenance. They set boundaries, even imperfect ones, around when they'll check markets and when they'll try to be present in their non-trading life. They find meaning in the intellectual challenge of trading rather than just in the money, because the money alone proves to be an insufficient motivation to sustain the effort over decades. There's also something deeply satisfying about trading when you're doing it well. The intellectual challenge is real and engaging. Markets are endlessly complex, and there's always something new to learn, some pattern you haven't seen before, some situation that requires creative thinking. When you make a call that goes right, when your analysis proves correct, and you profit from insights that others missed, there's a genuine thrill that has nothing to do with ego and everything to do with the satisfaction of understanding something difficult. And despite the stress and the pressure, there's freedom in trading that's rare in other high-paying professions. You're measured purely on results. Nobody cares if you took a 2-hour lunch or came in late or wore jeans to the office, as long as you're making money. If you're trading your own capital, you can work from anywhere with an internet connection. You're not sitting in endless meetings or navigating corporate politics or pretending to be busy. You're engaged in something real and measurable, where the results speak for themselves. The camaraderie among traders when you find it is also special. You're bonded by shared experience and mutual understanding of what this work demands. War stories from particularly volatile trading days, legendary tales of spectacular wins, or catastrophic losses by famous traders, debates about market structure and strategy. This forms a kind of professional culture that's insular but genuine. You can talk to another trader and be understood in ways that are difficult with people outside the profession. Looking back on any given day, you realize how much has happened in those 12 or 14 hours. Hundreds of decisions made, thousands of pieces of information processed, millions of dollars moved. And tomorrow, you'll do it all again, with fresh positions and new opportunities and the same fundamental challenge: trying to read the market correctly while managing risk intelligently. The cycle continues day after day, each one bringing its own unique set of circumstances and challenges. Some days, you drive home feeling invincible, having navigated volatile markets successfully and generated strong returns. Your read on market psychology was correct. Your timing was good. Your execution was crisp. Those days make everything else worthwhile. Other days, you drive home feeling like an imposter, having misread situations and lost money on trades that seemed obvious in retrospect. Those days test your resilience and force you to confront your limitations. Most days fall somewhere in between, neither terrible nor great, just another day of trying to do difficult work well under challenging circumstances. The question of whether it's worth it, whether the financial rewards and intellectual engagement justify the stress and lifestyle demands, is one each trader has to answer for themselves. For some people, trading is their calling. They genuinely love the challenge, thrive under pressure, and can't imagine doing anything else. For others, it's a phase in their career, something they do for a few intense years before moving on to less demanding work. Neither path is wrong. Trading isn't for everyone, And there's no shame in recognizing that the costs outweigh the benefits for you personally. What is certain is that trading changes you. It teaches you about discipline and emotional control in ways that few other activities can. It humbles you repeatedly, reminding you that no matter how smart you think you are, the market is smarter and more unpredictable. It sharpens your ability to make decisions under pressure and to live with the consequences of those decisions. It provides a kind of education in risk, probability, and human psychology that's genuinely valuable, even if you eventually leave the profession. As you finally close your laptop for the night and try to let your mind settle, you're already thinking about tomorrow. What will the Asian markets do overnight? How will that earnings report coming out tomorrow morning affect your positions? What opportunities might emerge? The mental wheels keep turning, because being a trader isn't something you do, it's something you become. It seeps into your consciousness and changes how you see the world, making you constantly aware of risk and opportunity, forever calculating probabilities and outcomes. And when the alarm goes off tomorrow at an hour when most people are still deeply asleep, you'll get up and do it all again. Because this is what you've chosen. Or what has chosen you. This strange, demanding, exhilarating profession that rewards excellence and punishes complacency, that offers both tremendous opportunity and substantial risk, that exists at the intersection of mathematics and psychology, technology and intuition, discipline and creativity. This is the life of an equity trader, and for all its challenges, there's nowhere else you'd rather be.